Hello everyone, hope you all are doing well. So today we are going to discuss March-June 23 question number 1. This is day 1 of March-June 23 question number 1. Previously we have discussed and solved the December 2022 past paper which you can check in the ACCA PassPoint past paper topic wise past paper playlist. This lecture will also be uploaded on this YouTube channel and on the same playlist. Okay, this is question number 1. We all know question number 1 include 4 parts and the marks allocated to question number 1 is 50. This is section A, question number 1 for the 50 marks. Out of 50 marks, 10 marks are for the professional skills. Part A usually comes on the business risk, but in this question, the part A comes on the risk of material misstatement. Part B comes on the significant risk of material misstatement for the inventory and audit procedures. And part C is about the ethical and professional issues. If you watched my December 2022 question number 1 Mercurio company, you will have an idea you got an idea about the structure of the question number 1. Let's start this question. Okay, let's move to the question. So this is question number 1, March June 23. Make sure you open this question on your CBE platform, or it should be downloaded in your laptop or whatever device you are using. It is 1st July 2005. Dates are very important. It is 1st July 2005. You are a manager in the audit department of Garrick and Company, a firm of certified chartered accountant. You are assigned to the audit of Encore Company, which has a financial year ending 30th September 2005 and is a new audit client of your firm. Highlight this one. This is a new audit client. It will help us in materiality. Encore Company designs and builds boards which are used in the fishing industry. Each board is created to a specific customer order. The following exhibits, left-hand side, provide information relevant to the question. This information should be used to answer the question requirement within your chosen response action. Let's go through the requirement. Respond to the instructions in the email from the audit engagement partner. The split of the mark allocation is shown in Exhibit 1 partner's email. Professional marks will be awarded for the demonstration of skill in communication, analysis, and evaluation, professional skepticism and judgment, and commercial acumen. We will go through one by one. Now, let's read the exhibit number 1 partner's email. So we all know when we start solving the question for the briefing, to become from and from become the true. Now this is from the partner side. So to from us, so we are audit managers, and from means engagement partner. Isabel Phoenix audit engagement partner. Subject audit planning for Encore Company. Date 1st July 2005. Hello, I have provided you with some information which you should use to help you with the planning of Encore Company, our new audit client, for the financial year ending 30th September 20x5. When determining materiality, please use revenue as your basis. Means engagement partner specified that we should have to use the revenue as basis for the materiality. I have concluded that revenue is an appropriate basis for materiality as the company's revenue has historically been stable. I require you to prepare briefing notes for my own use in which you A. Using exhibits 1, 2, 3. If a partner specify using these exhibits, then we don't need to go through exhibit 4 and 5 for part A. Evaluate and prioritize. Evaluate and prioritize. If you watch the December 2022 question number 1 lecture, then you are much familiar. Evaluate and prioritize the significant risk of material misstatement to be considered in planning the audit. Note, you are not required to consider risk of material misstatement relating to inventory at this point, as this will be dealt with in part B. Means whenever there is a risk of material misstatement related to inventory, we should not consider in part A, as the examiner asked in part B. Using exhibit 3 and 4, justify why inventory has been identified as a significant risk of material misstatement, and design the audit procedures which should be included in the audit plan to address those risks. Part C, using exhibit 5. Part C related to exhibit 5 only. Using exhibit 5, evaluate any ethical and professional issues raised and recommend any actions to be taken by Garrick Company. Overall, the requirements are easy. Let's identify the audit or risk of material misstatements. Okay, let's read the background information. Encore Company was established 10 years ago by three engineers and has become a well-respected company in the design and manufacture of large boats used in the commercial fishing industry. The company is relatively small with only two people working in the finance department. Highlight this thing, it will help us in writing a control risk. For the last 6 years, the directors engaged another audit firm, Coach and Company, as they believe that external audit provides credibility to the financial statement, which has helped the company secure finance. Means previously it was audited by Coach and Company. The audit opinions issued by Coach and Company have been unmodified each year. The audit firm resigned due to a conflict of interest with another of their audit clients. Highlight this thing, it will help us in identifying the integrity. Now, Encore Company owns two large premises in a town called Seville, where the boats are built. It also owns a dockyard, an area used for anchoring, repairing, and maintaining ships, where customers can rent a space to store their boats when they are not in use. Means the customer can store their boat. The company's head office is also located at the dockyard, both of which are capitalized and depreciated in accordance with their appropriate useful life. Highlight this thing as well. In core company typically works on 20 customer contracts at any one time. Boats are normally delivered to the customer as soon as they are complete and have undergone the necessary external safety inspection to receive a license to sail, which is when the company has completed its obligation under the contract with the customer. This paragraph is about the revenue recognition. Okay, now move to the notes from the meeting. In notes from the meeting, we will also get the figures for revenue on which we have to calculate the materiality. Developments in the air, payroll, outsourcing, and control deficiencies. Remember block 1, lecture number 9, outsourcing. In November 2004, the company employed a new finance director, Gavin B. When reviewing the company's internal controls over payroll, Gavin noticed several significant deficiencies, which meant that overtime payments were not always authorized and timesheets often went missing. Highlight for the control risk. Concerned about this, Gavin convinced the other directors that in core company should engage a service organization to deal with the company's payroll. We all know payroll is a material component of the financial statement. So whenever client outsource its function, we have to check the credibility, competence, and other things of the outsourcer, outsourced functional. From 1st June 2005, Bear Payroll Service BPS has provided an outsourced payroll service to the company. Okay, development number 2, joint arrangement, IFRS 11. Remember, in May 2005, Encore Company entered into a joint arrangement with ELM Associates, a company which designs luxury boats. The objective of the arrangement is the development of a new range of boards to be marketed to providers in the leisure industry. Encore Company has not contributed any cash to the joint arrangement but has provided two of its senior board designers to work on the project for several days. Gavin intends to recognize $75,000 as an intangible asset in the financial statements on the basis that part of this amount represents the time that the two engineers will spend on the project by the year end. Means in core just providing their two designers, whereas Gavin intend to recognize 75,000. The 75,000 also includes an element relating to intellectual property which the company is investing into the project. Historic board. On 1st June 2000 one of the company's shareholders gifted a historic board to the company. Okay. The company needs, if you remember, this is a related party. Okay. The company needs to develop an accounting policy in respect of the board as there is no specific IFRS. There is IAS standard dealing with this type of asset. Gavin B has valued the board at 50,000 and has recognized the board within property, plant, and equipment and included the 50,000 as an income with operating profit. The board will be on display outside the company's head office. Dockyard damage. On 15 June 2005, a severe storm caused damage to the company's dockyard, non-adjusting event. Property with a carrying amount of 108,000 and two boats which were being stored in rented spaces at the dockyard by customers were severely damaged, but the damage has not yet been quantified. Kevin believes that the company's insurance will cover the cost of the repairing the property and he has not adjusted the carrying amount of the property in the financial statement. He has recognized a receivable and deferred income of 110,000 related to the amount claimed on the insurance. This is wrong. Why? Because if you know the concept of contingent asset, if it is probable, then disclose. If it is virtually certain, then only asset can be recognized. Though the amount is not likely to be received until November 2005. Now, financial information. The company's projected revenue for the year is 4.9, which we use for the materiality, 0.5% to 1%. And projected operating profit is 0.588 million. Operating profit includes payroll cost of 2 million. The company's projected total assets at 30th September 20x5 are 0.995 million. Let's solve for the part A, then we will move to the part B. Okay. So if you can see, I have written down how you will have to fetch the professional skills mark: communication, analysis and evaluation, professional skepticism and judgment, commercial acumen. I would like you to read this. If you are not able to understand, then you can watch the December 2022 question number 1 video. Okay. First, you will have to write question number 1 in core company briefing note heading to Isabel Phoenix, audit engagement partner from you, audit manager, subject audit planning, date 1st July. This is copy paste from the partner's email. Just change from to from. Okay. Introduction. This is all copy paste from the requirements. The purpose of this briefing note is to prioritize the significant risk of material misstatement part A and the risk of material misstatement related to inventory part B, procedures part B, and ethical issues part C. Let's solve risk of material misstatement part A. First, you have to write a materiality heading and then you have to calculate the materiality. The materiality of Encore company is determined based on the total revenue as suggested by the partner. The threshold used in the determination of the materiality based on revenue is 0.5% to 1%. The materiality at the lower end of 0.5% is 0.0245. How you calculate this figure? If you remember, the profit figure was 4. Let me check again. The profit figure was Yeah, it was 4.9 million, and 4.9 million multiplied by 0.5 gives you this figure. Whereas at the upper end of 1%, the materiality is 0.049. 1% multiplied by 49 gives you this figure. Now, once you calculate the materiality on both ends, then you will have to choose one of them. How will you choose? It's your judgment. If you remember, it's mentioned in the question's introductory paragraph that this is a new client. First thing is the client is a new client, and the second thing is there are risk of material misstatement. So what do you think? We have no prior knowledge of the client and there are developments, means there are risks. So based on that, we should choose lower end. Why? Because if you remember, whenever there are risks, materiality threshold should be lower, means we can have to perform extra sample size. As in core companies, a new audit client of Garrick and Company, and also the risk of material misstatements were identified. So based on that, the materiality should be determined at the lower end, 0.025 million. Materiality and risk have an inverse relation. Higher the materiality, lower the risk. Higher means this percentage. Okay. Don't go for the higher amount. Risk of material misstatement. First, this is a new client. This is a new client. Okay. In core companies, a new audit client of Garrick and Company. So based on that, Garrick and Company might not be familiar with the operations and structure of in core company. Garrick and Company should obtain an understanding of the in core company's management and directors to ensure their integrity. Further, there is a high risk of opening balances as there is a possibility that the opening balances might not be brought forward correctly. Means last year closing balances were not be brought correctly brought forward this year. So based on the less information about in core company and the high risk of opening balances, there is a detection risk. This line you will only write when the examiner asks you about the audit risk. Okay, if you remember or if you watch my lecture on the risk, so there is an equation of the audit risk. Audit risk is equal to detection risk multiplied by risk of material misstatement. So from so to till procedures, as it includes detection risk. The detection risk will only come if the client is a new and the examiner asks you about the audit risk. In risk of material misstatement, you don't need to write this line. So there is a question why I have written this line. It's just for your understanding because most of the students mention this thing in risk of material misstatement as well. So that's why I have written when I record this video so I can explain it to you. And when you watch this video and this slide, so it gives you a hint that don't need to write detection risk in the risk of material misstatement. So based on the less information about in core company and the high risk of opening balances, there is a detection risk only in case of audit risk question that can affect the overall audit if Garrick and company is unable to perform procedures. Now, revenue. The amount of the revenue 4.9 million is material to the financial statement as it is above the materiality amount. As per IFRS 15, revenue from contract with customer revenue should only be recognized when the performance obligation is satisfied. First, you write the materiality line, then accounting treatment. After this, in this case, there are two performance obligations. One is when the in-core company completes the board work, and the other one is undergoing safety inspection for a license to sale. Remember, it's written in here. Delivered to customer as soon as they are complete and have undergone the necessary external safety inspection. For license to sale. Therefore, revenue should be recorded when both the conditions attached to the contract are fulfilled. You mention this thing. Now, what is the risk and its impact? In core company, typically work on 20 customer contracts at any one time. Therefore, there is a risk that the revenue might be recorded at one time, which results in overstatement of revenue. However, it can be analyzed that the projected revenue for this year has increased by 5%. How you calculate this percentage? Compare this year revenue with the last year, you will get the percentage. This year revenue minus last year revenue divided by last year revenue gives you the percentage increase or decrease, which might include the impact of recording the revenue from both customers in advance. So this is how you have to fetch your marks and how you have to draft your risk questions. Again, I am repeating, first you have to write the materiality, then accounting treatment, then issue risk and its impact. Payroll. The amount of the payroll outsourced 2 million is material to the financial statement. Where it's mentioned 2 million, it's mentioned here. 2 million cost, payroll cost 2 million, operating profit includes payroll cost of 2 million. Remember, they outsource it to BPS. Okay. The amount of the payrolls outsourced 2 million is material to the financial statement as it is above the amount of materiality 0.0245. As the outsourced service is material, it should be dealt with skeptically by Garrick and Company, our audit firm, to ensure the independence and competence of BPS. As the amount of payroll increased by only 5.3% this year, shows that there is still weakness in payroll records. This further increases the risk of management bias as management override controls by not recording overtime and authorizing the timesheets. Override means management is not maintaining or promoting their control, means they are violating their own control. So management overrides of control by not recording overtime and authorizing the timesheets. This mentioned in the question. Therefore, there is a risk of incorrect payroll records, which results in an understatement of payroll as BPS only hires just before the 4 months of the year end. Also, it increases the risk of other control weakness, as there might be a possibility of errors or fraud which not prevented and detected by the management, due to which high risk of material misstatement. If you remember, it's mentioned in the question that the previous auditor has resigned or removed due to conflict of interest. So don't you think there is a possibility that they hire us and they hire BPS just for the 4 months before so they can manipulate most of the financial figures? This can be a possibility. So we have to be skeptical and work with due diligence as it can affect the auditor's professional liability. Now, capitalization of development cost. The amount of the total assets of Encore company on 30th September 0.995 is material to the financial statement as it is above the amount of materiality determined above. As per IA 16, this is very important, please be attentive. As per IAS 16, there should be a proper classification between the revenue and the capital expenditures. Why? Because revenue expense are expense out and capital expenditures are capitalized. However, in core company owns two large premises in a town called Seville where the boats are built. There is a possibility that the cost of capitalization in relation to both is not appropriately accounted for, means there is a misclassification. Therefore, there is a risk of incorrect classification or misclassification between revenue and capital expenditure, which may result in under or overstatement of assets as the increase in assets this year is 13.6%. So this is a high significant increase. Also, there is a risk of incorrect depreciation charged by the management of Encore company as the director seeking finance from the bank, due to which management may manipulate the financial figures for the better presentation instead of true and fair view. We all know Financial statement should present true and fair view rather than the better presentation. Better presentation is for the shareholders or for the financial investors so that we can please them. Also, it can be seen that the increase in operating expenses is only 3.4% as compared to last year, which is not justifiable. Therefore, there is a risk of understatement of expenses as the depreciation may not be accounted for appropriately or using incorrect useful lives. We all know useful lives is an estimate. So whenever there is an estimate, it includes subjectivity and complexity. Now, joint venture. Remember, Gavin B. The amount of the intangible assets associated with the JV joint venture 0.075 million is material to the financial statement as it is above the amount of materiality. As per IFRS 11 joint arrangement, there must be joint control, means unanimous consent of all the parties. In this case, there are two parties. Further, joint arrangement is specified into two types, joint operation and joint venture. The objective of the arrangement is the development of a new range of boats to be marketed to providers in the leisure industry is a joint operation. Why this is a joint operation, not a joint venture? As they don't make a new company. In joint operation, all the parties have a direct interest in assets, liabilities, income, and expenses. In core companies should recognize the intangible assets only to the extent where an element relating to the intellectual property which the company is investing in the project. However, in core company does not contribute any cash to this arrangement except for the two senior designers and there are no specific terms related to any contribution. So in core company should not recognize the full 75,000 as an intangible assets. Therefore, due to incorrect recording of intangible assets, there is an overstatement of non-current assets. Now, if you note, there is a one mistake. What is the mistake? First one is the heading joint venture, and the second one is joint venture is there. This is just a writing mistake. Please correct it. Joint arrangement. Also, here write joint arrangement. This is not a joint venture. This is a joint operation. But I mistakenly write joint venture. Please correct it. Joint arrangement, and the heading should be joint arrangement. Now, if you don't remember the concept of joint arrangement, it's very small standard IFRS 11. I will upload all the IFRS standard link in this video description. You will see the link here or there. Okay. But let me just give you a overview. What is joint venture and joint arrangement? Joint venture means when two parties is going to create a separate entity, separate vehicle, separate company through which they start their business. Whenever there is a joint venture, it should be recorded as per IAS 28, joint investment in associate. Whenever there is a joint operation, it means both the parties want to work together but on the existing industries. In this case, no separate vehicle, no separate entity. So what is the accounting treatment? The accounting treatment is both the parties record their shares of assets, liabilities, interest, and expense. So in case of joint arrangement, sorry, joint operation, both the parties record their percentage of assets, liabilities, interest, and expense, sorry, income and expense. But in case of joint venture, we use associate accounting, equity method accounting. Okay. Now, risk number 6, disagreement with previous auditor. Remember, last 6 years it was audited by another auditor firm, which is Coach and Company. Coach and Company, the previous auditor of Encore Company, resigned due to a conflict of interest with another of their audit clients. Carrick and Company should communicate with the Coach and Company to identify the reasons for their resignation. From the current engagement, the directors believe that external audit provides credibility to the financial statement, which has helped the company to secure finance. This shows that the directors have an expectation gap regarding the audit of the financial statement. Means director believe that the external audit report is so powerful. Once we present it to the financial institutor, they can give us a loan. No, this is wrong. Therefore, there is a high risk of negligence in the professional liability of Garrick and Company, as in core company is seeking finance based on the audit report. So, Garrick and Company should reduce the expectation gap of the directors in order to protect its liability, professional liability. Small company. In core company is relatively small with only two people working in the finance department. In such companies, internal controls are weak as there is a lack of segregation of duties and no proper monitoring of internal controls, which you can link with the payroll overtime not authorized and approved. However, in this case, it is evident that there is a lack of segregation of duties as only two people working in the finance department can misappropriate the cash. In the end, you have to give a conclusion. The significant risk of material misstatement are prioritized based on new client. First, I have written down the new client, then the amount of materiality. After new client, all the risks are based on materiality. The risk with the higher materiality comes first, then second, then third, and go on. Again, if there is a question on the audit risk, then you have to write about this line. Detection risk being the most significant risk is prioritized above all other risks. Based on materiality, the risk prioritized are revenue, payroll, and so on. Please, I am repeating again, if the question asks you about audit risk, then include detection risk. Otherwise, do not need to write detection risk because ROMM is the component of inherent risk and controlled risk. Now move to the B inventory ROMM. Let's read the question. Okay. So this is exhibit number 4, inventory. So raw material, WIP, finished goods. First we have in the form of raw material, then we work on it. It becomes WIP. Once it done, it becomes a finished good. We can sell it in the market. We have to check the quantity and amount of each of these components, RM, WIP, and finished goods. Now, Isabella Phoenix, the audit engagement partner, thinks that based on her initial review, inventory gave rise to a significant risk of material misstatement. She would like you to justify this because the briefing notes will be used to explain the audit approach to the audit team and to recommend relevant audit procedures in response to the specific risk identified. Information extracted from the latest management accounts in respect of inventory is given. There are three notes for each R, M, WIP, and finished goods. First, check their amounts. Okay, raw material 24 this year, it was 16 last year. WIP 533 this year, 484 last year. So it means there is an increase. Finished goods 80 this year, last year it was 44. Let's read one by one. Raw material. Okay. Raw material. The company tries to minimize the amount of raw materials stored at its premises, but to take advantage of a discount offered. On a bulk purchase from a supplier, a large quantity of aluminum was purchased in June 2005. In the in respect of the increase of raw material, the examiner mentioned that in core company purchased large bulk of aluminum in June 2005 as it was on a discounted price. Now, we all know if we purchase something on a bulk, at that time there was a discount, but what if at the later stage or in the next term the prices go further down? So don't you think it affects the inventory? and we have to record it at lower of cost or NRV. Let's read the answer. Inventory ROMM raw material. The amount of the raw material 0.024 is material to the financial statement as it is above below the amount of materiality as calculated above. We use the same materiality for the overall question answer. As per IAS2, inventory shall be measured at lower of cost or NRV. In core company bought a significant quantity of aluminium due to a heavy discount on its price. Therefore, there is a risk that the aluminium may be obsolete. How aluminium may become obsolete? Obsolete means price goes down. As the prices goes down and the management may not record it at NRV, this may result in an overstatement of raw material and understatement of expenses, as can be seen that a significant 50% increase in raw material as compared to last year. I have performed the audit of steel, aluminium, and iron entities, and it is a real case that sometimes they purchase the foam bars and pellets in the bulk quantity. Why? Because at the time the steel prices were low. But what happened in the future? Later stages, the price went further go down due to any economic crisis, and at that time there is also an economic crisis in that specific country. So most of the constructions work will stop, and their aluminium or iron bars or other iron materials remain in their storage facilities. So it affects the entity's operations. So this is for the raw material. Let's read the WIP. Again, it is increases from 484 to 533. Work in process. The direct costs relating to each contract are recorded in the job costing system. Okay, this is a system in which they record their direct cost. Raw materials relevant for each contract are input as they are used, and payroll costs are input manually using timesheets which records the hours spent by different engineers working on each contract. Highlight this line. The direct costs are used as the basis for adding production overheads, which are included at 10% of the direct cost. The company's finance director estimates the percentage completion of each contract at the financial year end. Whenever there is an estimate, it means judgment and subjectivity. Let's solve this one. Work in progress. The amount of the work in progress 0.533 is material to the financial statement as it is above the amount of materiality. WIP includes raw material cost and direct labor cost, means the production labor which work on the process, and production overheads. Okay, this is just copy paste from the question. Now payroll costs are included manually using timesheets in the direct cost on which production cost at 10% calculated. Again copy paste from the question. Due to the incorrect recording of payroll cost into the direct cost, production overheads were also calculated incorrectly. Therefore, due to this incorrect calculation, there is a risk of understatement of WIP cost as it only increased by 10% this year. Despite the fact that in core company made a joint arrangement with Alice Associates. Also, you can write it includes an estimate. So whenever there is an estimate, high chances of manipulation or judgment. Now for the finished goods. Okay, finished goods amount also increased. So finished goods, what an examiner mentioned. Currently, one board which has received its license to sale is being stored at the company's premises as the customer cannot take delivery until October 2000 X5. Means year end has passed and still the customer has not taken the delivery. A second board is awaiting a second safety inspection. Having failed the first inspection due to faulty safety equipment being installed. means the first boat is ready but the customer is not taken the delivery, and the second boat is awaiting for their safety inspection. Previously it was failed its first inspection. The amount of the finished goods 0.08 is material to the financial statement as it is above the amount of materiality. The first boat that has received its sailing license is stored at the Encore company's premises as the customer can't take delivery until October 2000 which is after the year end. There is a risk that customer cancels the order and the boat will remain unsold, which results in a reduction in subsequent sale price. Also, you can link it with the revenue. Also, the second boat failed the first safety inspection and is awaiting its second inspection, which might have failed. Therefore, there is a risk of NRV loss, which management might not record. And due to this, inventory will be overstated. Now, audit procedures. Review the purchase invoices on a sample basis to confirm the bulk discount and the cost of raw material purchase. You will obtain the invoices and check how much discount is in core company offered. Discuss with management the implications of the reductions in the aluminum purchase prices. Recalculate the working of the direct cost to ensure the accuracy of the management calculation. Also, you can ask management to provide a quotation of the supplier from whom they purchase. You can also compare it with other supplier quotations, so it will give you the idea whether in core company is right or wrong. Discuss with the production head manager the basis of inputting the payroll cost manually. Inspect the job cost system to ensure that the correct direct costs are recorded in the system. Obtain the attendance report of the engineers and compare it with the timesheets on which hours spent by engineers are recorded. Correspondence with the customer to confirm the expected date of the delivery of the boat, if any. Discuss with the safety inspector to confirm the updated status of the second safety inspection. We are done with part B as well. Now, part C, ethical issues. Let's move to the final exhibit, which is finance director's request. Okay. So, Gavin B has requested that Garrick and company perform an additional service to conduct a detailed review of some of the company's internal controls and to recommend improvements. Okay. Although this is an engagement usually performed by an internal audit team, Gavin has suggested that because the external audit will include work on internal controls. No, this is wrong. This additional work would not incur an additional fee. Oh, as it should be included within the audit fee. Again, self-interest threat. The internal controls falling under the scope of this review are not all directly related to the financial reporting process. Second, the company has recently applied to their bank for additional finance of 60,000 to be used in the joint arrangement with ELM Associates. Gavin B has asked whether Garrick and Company can provide a guarantee for this finance. Remember, advocacy threat. Let's solve this one. Gavin B has requested that Garrick and Company perform an additional service to conduct a detailed review of some of the company's internal controls and to recommend improvements. This results in a threat to self-review and management. Self-review thread is created as if Garrick and company review the control this year, then next year the audit team will rely on such controls without checking its operating effectiveness. If you watch topic-wise past paper questions on professional skepticism, in which examiner mentioned so many times that the audit team did not perform test of control or test of trade this year as they rely on the last year. So this result in self-review threat. Management threat. This is the most significant threat. It can't be reduced by any safeguard. So make sure you have to be very clear about these threats. Management threat is created because it is the responsibility of the management to design and implement internal control to ensure its operating effectiveness. If Garrick and Company reviews in detail, then it is considered as Garrick and Company stepping into the role of management, which is a significant threat and will not be mitigated by any safeguard except for the refusal of the service means you have to withdraw from this engagement. Gavin has suggested that because the external audit will include work on internal control. This additional work would not incur an additional fee as it should be included in the audit fee. Complete line copy paste from the question. This is an additional service and should be separated from the audit fee. Further, if Garrick and Company offers such a service to Encore Company, then it results in a self-interest threat, as the financial interest of the audit team may be influenced due to additional fees. Gavin B has asked whether Garrick and Company can provide a guarantee for this finance. This results in an advocacy threat and self-review threat. An advocacy threat is created if Garrick and Company provides a guarantee to the bank which shows that the audit team is promoting the interest of Encore Company in securing this loan amount of 60,000 for the joint arrangement. Further, a self-review thread is created because of material component of the loan amount. Audit team members are reluctant to review the loan amount in next year's audit if they provide a guarantee of this loan amount to the bank. So that's it for ethics as well. If you have any questions or any queries about any topic or any past paper questions, please comment down. I will try to communicate with you on the same day or on the next day. Take care and best wishes.